Most investors focus on returns, but the math that actually determines your outcome is something else entirely. Warren Buffett, one of the greatest investors of all time, has a famous quote, and it goes something like this. Rule number one, don't lose money. Rule number two, don't forget rule number one. Now, I wouldn't take that quote literally, but at the same time, this is one of the most important ideas a successful investor can understand. Not because losses never happen, they certainly do, but because large losses are what make long-term gains much more difficult. A 20% loss takes a 25% gain to come back from. A 30% loss takes a 43% gain. A 40% loss takes a 67% gain. And a 50% loss takes a 100% gain. Now, here's what most investors don't realize. Losses beyond 20% require surprisingly large gains just to get back to even. Now, that's the math behind what Buffett is saying. So now the question becomes, how do you avoid large losses? The challenge is markets don't avoid large losses. In fact, the S&P 500 has dropped 50% twice in the last 25 years. Once starting in 2000 and again in 2007. Could it happen again? Yes, absolutely. To deal with 50% losses, you either need an iron stomach or some form of defense. A 50% loss when you have $100,000 is painful, but a 50% loss when you have $1 million is something else entirely, especially for people approaching retirement. Now think about this. If you lose 50% of your money, you need 100% gain just to get back to where you started. Now, how long does that take? Well, it depends, but it could take years. There are a few ways to think about this. A diversified portfolio, assets that aren't highly correlated, maybe some high quality bonds or possibly cash. Now, that's the standard advice. But I approach this differently. I prefer something called trend following. I don't build static portfolios. I build portfolios that can move incrementally from defense to offense or anywhere in between. And it's important to understand, I'm not trying to predict markets or maximize short-term returns. I'm trying to build portfolios that can adapt to different environments and help clients stay disciplined over time. Here's another way to think about it. A portfolio that earns 7% consistently for 10 years can outperform one that earns 10% for 9 years and then loses 20% on the 10th year. Avoiding large losses matters more than chasing higher returns. That's the math of defense. And it's why defense isn't optional. It's the foundation that makes long-term growth possible. And this is exactly where most investors make the biggest mistake, especially in weak markets. I recently put together a deeper commentary on how this actually plays out in real time and what a more defensive approach actually looks like when markets start to get weaker.